looking out to 2020, it just seems the consensus view is for rates to remain where they are or go lower. Where do you come down in that debate right now?
Yeah, I think that that's probably right, that the rates will probably drift lower. That's been the story of the last 10 years. We've had no inflation. We're in a record expansion. We can't generate any inflation right now. Rates are down 75 basis points this year, at least on the 10-year yield. The path to least resistance has been for a decade lower, and I see no reason to think that that's going to change going into 2020.
Kathy Jones, your take?
Well, actually, we're calling for higher rates this year. Not a huge breakout to the upside, but we're looking for 2.25%. Stretch to 2.5% on the 10-year. And the reason is, unlike last year, we were starting at a higher level with the economy slowing down. Now we're starting at a lower level with the economy looking a little bit better, the global economy in particular. And we see room for the term premium to come up a little bit, inflation expectations to pick up a little bit.
George Bory?
Yeah, I'd say we're in a similar camp in the sense that we think that rates have room to move up from here. Roughly 2.25 is sort of our target.
Yeah.
And I think you can kind of summarize it in a very simple way. We expect growth to be upwards of 2%. We think inflation is going to be around 2%, and we think the 10-year yield on average will be about 2%. So it's kind of a 2 by 2 by 2 forecast, if you will.
Similar data points that we've experienced this year as well. So what has taken us to 225 when we experienced rates of in and around 150 with exactly the same economic backdrop this year that you're predicting also to repeat next year?
Yeah, well, I think like Kathy said, I think the difference is growth differentials. And although the economy decelerated this year, our expectation is the economy is going to pick up a little bit and start to re-accelerate next year. That in and of itself will allow yields to move a little bit higher. And we think the Fed's going to be anchored. We don't think the Fed's going to do anything. So, the monetary stimulus you saw in the middle of this year starts to filter its way through both domestically and internationally, and that just basically helps boost growth incrementally.
Jim, we're arguing over 25, 50 basis points maybe, but what are your thoughts on GDP starting to pick up again as the new year starts to grow a little bit older?
I think that there's possibility that it can pick up, but I'd also remind you that the U.S. rates, with a 2 handle on the 30-year, we have the highest rates in the developed world for the first time in history. I think that really global rates, global growth is what matters for the bond market. And with all those other rates being lower and a lot of them being negative, and they're going to probably stay there, that's going to be a tremendous downward pull on our interest rates. We cannot remain the outlier, I don't think, in terms of interest rates. We've never been here before as the highest rate, and I don't think that it's going to stay that way for much longer. So either the rest of the world's going to have to come up a lot, or we're going to continue to be pulled lower, and I think the pulled lower is going to be what we'll see first.
Well, Jim, let's talk about what that means for the shape of the yield curve as well. George, your thoughts on that? 2s out to 10s. We're ending 2019 with some steepness relative to where we have been, the inversion of the middle part of this year and through the summer. 2s to 10s, add to around about 30 basis points. Your take?
Right. So we think there could be another, sort of 10, maybe as much as 15 basis points in steepening. But I would say 5 to 10 is probably a good central call as the Fed kind of stays anchored. You get a modest uplift in yield. So that's one of our highest conviction views, is just position for a steeper yield curve next year. And we think that kind of positioning is going to work best for you.
Kathy?
Yeah, I would agree. Looking for a steeper yield curve because the Fed is going to stay on hold. I think if there's a surprise this year, is that we do get a little bit of a lift in inflation and inflation expectations. It's starting to build a little bit, and we've seen the break-evens in the TIPS market come up. So I think if there's a bit of a surprise, it might be a little bit more inflation, or at least the expectation of it, than we've seen before.
Well, let's start to probe what that means for the consensus call going into next year. There is just this overwhelming belief, and this is a take from Morgan Stanley, which I know is shared by many people watching this program and across Wall Street, that risks are skewed asymmetrically to cuts over hikes in 2020, that the reaction function of the Federal Reserve has shifted. Is that your take too, Kathy?
Well, I think they definitely would need to see, as Jay Powell said, a material change in the outlook to make a change. And I think the interpretation of that was, boy, we'd have to see a much worse economy in order to start cutting again, and we're not even considering raising rates. But if we're right that we see a little bit more upward pressure on inflation, that sort of expectation might shift in the second half of the year.
Jim Bianco, do you share that view, just to bring you back into the conversation, that the Fed is just not going anywhere through 2020? Do you have an understanding of the threshold that would bring the Fed back to the table?
No, and I don't know if any of us really do. Remember, the Fed did this big Fed Listens tour throughout 2019, and they're going to, in the first half of next year, roll out some kind of a new policy directive. It's expected to be some kind of an average inflation targeting policy, which means that even if we get that uptick of inflation expectations, the Fed is going to allow it to happen without even considering raising rates. So I think that raising rates, unless something dramatic happens, is off the table. Lowering rates, now there's a lot of things that could happen that could make rates go lower. The uncertainty around more trade, the phase 2 talks, the elections, and don't forget just a correction in the stock market. As much as they want to say that doesn't matter, it does, and it does every time it happens.
So, Jim, how do you push that view through the rest of the yield curve? Presumably the front end would be pretty anchored in the environment that you describe. What does it mean for further out?
Yeah, I think the front end is going to stay anchored. I do think that if long rates come down, the problem with the yield curve is it's a corollary to your rate call. Since I've got a rate call of lower, I think that the yield curve could be flatter. If there's going to be a surprise in the yield curve call, it's because the repo market does not seem to be fixed. I mean, we're going to get through year end, but we're going to continue to have $60 billion a month of buying of Treasury bills, and that could continue to push downward pressure. The funds rate is trading on the lower end of the target that the Fed has. With all that stimulus they're pumping in, there's a potential that they could break through, the funds rate could break through, and you could see a 140 or something on the 3-month bill without the Fed moving because of what's happening in the repo market.
Jim, one thing I try and do on a program like this is try and work out where the consensus is, where the growing theme is, where the growing consensus is going into a new year, and where you should be pushing back against that, where the pain trade is. Where is the pain trade for the 10-year yield through 2020, higher or lower?
See, I've always thought that the pain trade in the bond market has been lower. I think that most people are really scratching their head as to why we're at a one handle given all of the news, especially with the pain trade being really lower in Europe. And so therefore, I continue to think that is the pain trade right now. If we were to go to the low ones, especially without signs, as you saw in the top, without signs of a recession, if we were to start to go back towards where we were at the lows in August of this year and maybe even lower.
Your thoughts, George?
Yeah, I mean, the pain trade from a capital at risk standpoint would be materially higher rates. The tremendous amount of money has been put into the market across all of fixed income this year.
Yeah.
Massive inflows. And so a lot of that money is committed at very, very low yields. So, a 100 basis point jump in yields means significant capital losses or mark-to-market losses across the market. And I think, Jim has a very good point, but I think the high consensus view is the range, is a relatively tight range. And I would say it's basically, let's call it 150 to 225 is basically the range. You go outside of that range and vol will go through the roof because, number one, it would be a rush to capital protect if we're breaking above 225 and trending higher. And then if we do start to go below that 150 level, again, it's sort of duration extensions. It's, sort of people really, as Jim said, you're going to really see a meaningful scramble to kind of get yourself invested and stay invested in just a very, very low yield environment.
Final word, Kathy.
Well, I think the pain trade is lower, but for a different reason, and that's because spreads are very tight in the credit market. If we're going below 150, that means the economy is doing very poorly. Spreads are way too tight in that environment. So if we're going down there because we're on the cusp of recession, the yield chasing and this, sort of Goldilocks scenario for credit will have to reverse itself, and I think that's where the pain is.
You're saying we need a recessionary environment to experience some of these targets that are out there, 120, 125, sub 150. That's
Right.
what we need.
Yeah, I think so. And if we get that, that means that credit spreads are way too tight.